when purchasing a house to pay cash. If you do, you've done something really, really right. So when you go to possibly buy a home, there are some good things to it. Actually, there's a lot of good things to it. You can write off, sure. You can write off property taxes that you have to pay. You can take out interest that you have on your house payment. You can take off your taxes. So on that front, you can save some. You, of course, then have ownership of your residence. You don't have to worry about your rent getting increased or your lease being broken or the house you're in, someone trying to sell it while you're still living in it and you're having to find somewhere else to go. So that can also be another positive thing. And my pen works here. If the housing market as a whole, or even just in your area that you're living, gets hot, the value of your home can increase greatly. Over time, a little bit like the stock market, typically if you stay in a home long enough, you're going to see an increase in your price. So it's a little bit of an investment. I'm not going to go so far to call it one, but it's a little bit of one. Now, not so good things about buying a home. Okay? It's going to be harder for you sometimes to be able to go somewhere. Let's say all of a sudden you lose your job, but you find another great one, but it's 3 hours away. Now, if you have a home that you're having a difficult time selling, are you going to be able to afford to buy a place near new while you're waiting for your old one to sell? That can be a problem sometimes. When you're the homeowner and not renting, okay, and the faucet breaks, it's up to you to fix it, okay? If you end up getting a hole in the roof, again, unless it's something caused by nature or something, you're on the hook for it. So trying to keep up things, even with just normal maintenance, can be costly at times. And also, there is, even though there's a lot of positives, there is some financial risk. Now, in other words, I'll kind of break this down a little bit more. You're not going to want to go in to buying a house and have no money down. You don't want to we want to put as little into paying interest as humanly possible. So that can be a sizable thing, just having that. And again, the price can fluctuate. Oh my gosh, this is why Hardy's not an English teacher. Fluctuate. There we go. So yes, it can go up, but it also can go down. You can have housing crashes. I've lived through one. Shortly after I purchased my home, is when the housing market came in. Now, it's recovered since then. But if I'd have had to sell my house within the first 5 years I bought it, it would have been a bloodbath. So, again, you've got to take these things a little bit into consideration. So, when you take out a mortgage, this is basically, here comes that borrowing thing again. Okay, we're going to borrow money to pay for property. Typically, that's going to have a house on it. Sometimes, maybe you just buy land and you buy a house on it. But with a mortgage loan, typically you're going to pay it back in equal monthly payments for anywhere 15, 20, 30 years. Those are your typical mortgage lengths. Typically, you don't see them much smaller than that because when you're dropping 6 figures normally on something, that's not something you're going to be able to just whip off and get done in 10 years, 5 years, something like that. Unless you've got a really, really large down payment, which we're going to talk about here in a moment. Actually, I'm going to skip to that. I'll come back to the selling price. The money you pay up front for your home is the down payment. This is usually going to be, usually that's going to be somewhere at a low of 5% up to hopefully 20% of the sale price. Now, it's not going to talk about this today, but I'm going to for a minute. You want to try to get to that 20 as fast as you can. Otherwise, you have to pay this thing called PMI, which is private mortgage insurance. The mortgage company, until you get to that price, worries that you're going to default. So you have to pay the insurance to cover if you were to default for the bank, which has always seemed like a strange thing, but it's true. So the more you can put off, the better you're going to be. And then again, the selling price is just the agreed upon purchase price. They'll put a price out there for their property. Most of the time, you'll come back with a counter, and it goes back and forth a little bit, and then you come to an agreement, and you sign, and then that's the end of that. So, again, we're going to simplify several things here. I'm going to add in some pieces where I can, where I think we'll still be on top of things. But when your down payment is going to be the selling price times your percent down, 5%, 10%, 20%, whatever it happens to be. And then calculating the mortgage loan amount is the selling price minus the down payment. This is the part, though, oops. This would be the value that you're going to calculate interest on. Okay, so if you buy a house for $150,000, and you put 20% down, $30,000. The $120,000 is the amount you're going to be paying interest on. And again, we'll pull up a calculator while we're doing this to see how crazily ridiculous the amount of interest is going to get to be on this if we're not careful. So, I might even add that to one of the examples here. Dana and Joe are purchasing a $343,300 home in Colorado. They agreed to 25% down payment. What's the cost of the down payment? Okay. Down payments are one thing I will say with purchasing homes that are real straightforward. There's not a whole lot of wiggle room to it. So somewhere, somehow, and I say good job, Dana and Joe, they came up with $85,000 to put down towards this house, which will reduce that and make them pay less interest later, which is nice. They'll also avoid PMI because it's over 20%, which is also nice. So any of these are going to work that same way. Now, the mortgage loan, and this is where I'm going to add a piece to the side. We're not going to calculate what I'm going to talk about here, but we'll explain where it's so you can kind of have a knowledge in the future. Sarah and Andrew are purchasing a $505,000 home in California. They agree to a 10% down payment. What is the cost of the down payment? What is the amount of the loan needed to finance the purchase? Okay, perfect with the 10% to chat about this. So, Okay, they're going to pay $50,500 down. So the amount they're actually taking the mortgage out for is $454,500. But, okay, here's where I want you to see a little bit of reality with this and not just us throwing a couple of numbers on a piece of paper. So here, just a second, if I can get out of here. I'm trying to. There we go. So just to let you see. So private mortgage insurance, just to kind of let you see this, so let's see, we had $454,500 left. That definitely would be a 30-year. So that's probably accurate. Are they not going to give me the PMI? Oh, there it is. So as I'm looking at this, and I'm going, okay, so I put 10% down. Might be hard to see in the back. So the PMI premium is going to be $146 a month. So you're like, okay, so if that's true, I mean, that's $146 that's out of my pocket, but here's what I want you to see more than that. So here, just one more second here. So right now, take that back, just so you can kind of see. Okay, so the payment on this particular house, and then I'll kind of pull it back together here for us. Okay, let me get this back on here. So the typical payment on this house would be a little over $3,200. Now again, property taxes, home insurance, other things like that we're still not taking into consideration. But here's what I want you to ponder. Having to pay that personal mortgage, the private mortgage insurance on top of it, is adding almost an extra 5% penalty to what you're paying every month, besides the 5 to 7% interest you're already paying. That gets to be crazy. How crazy, Hardy? I got one more thing I'm going to pull up here. So, which one do I want to do? Actually, let's do this. What I want you to see is how much you're going to end up spending at the end, sort of like we did before. So just as an FYI here, so we did 505. Down payment was $50,500. So now, if we look at this, I don't want to do all that. Get off my screen. Okay. This is the number I want you looking at. Okay? Your $500,000 house, total interest paid over the life of the loan. Interest paid, $506,000. When you're done with your 30-year mortgage, your $500,000 house is almost $1 million. Not including your home insurance and your taxes. I mean, we're pushing, I don't know, almost $1.1 million for a $500,000 house, which is why when I say, when you have an opportunity to buy something smaller or save up until you have a larger down payment, I'm trying to save you like double the price of your house. I'm just saying, just something to consider. So when we're looking at this stuff, and again, the practice problems for this one are down at the bottom. A couple of the down payments, a couple of the mortgage loan amounts, but do think a little bit about PMI and the interest you're paying, because this is going to be one of the little mini project things that we do when we get done with this, as you kind of go shopping around trying to figure out these things. where you live, how big is the house, what's the mortgage rate, stuff like that can really be a big deal. So, okay, Hardy off his soapbox on that one. So, speaking of interest, one last piece of things for today. So, when we start to chat about interest, and we're going to chat about how much your monthly payment should be. That's a little later in the unit, though. We know how interest works. That's the word we don't like. The amount paid to loan a bank's money. I don't have enough money, so I need to borrow your money. Okay, well, you're going to have to give me more money to borrow my money. Okay, that's fine. So what a banker will do, or a mortgage company will do, when they figure out how much do you want a loan for and how long you're going to do it, okay, they're going to come up with equal payments which include principal and interest until the loan is paid off. They can tell you on day one exactly when it's going to be done, how much you have left each and every month for the next 15, 20, 30 years. And so basically what you're going to get into is a chart kind of like the one that we've got down here to the left, where we're going to be like, okay, my monthly payment is going to be the amount of that mortgage divided by 1,000. Even though sometimes you can get mortgages in the millions, but we use the 1,000 to kind of keep the numbers a little more standard for everybody. Times the monthly payment for if the loan was $1,000. So we're going to get a multiplier in here to do this. We'll get to see that here shortly. You can kind of get a little bit of a taste into the idea of how mortgage companies work and what you're actually paying in a smaller sense. So the amount you pay is your monthly payment times the total number of payments, which will not equal the amount of your loan. It'll be more because we've got interest that we have to pay. That was kind of like that other screen I showed you where we had the extra, $500,000 worth of interest that we were paying. So your total interest, if I don't have a computer doing it for me, is the amount of paid minus the amount of the initial mortgage you took out, or the initial loan that you took out. So that's why we had, $994,000, I think it was on that screen, minus $505,000 makes how much interest that we paid. So if I'm actually trying to do a little bit of calculating myself, because I know how much I can afford or something like that, find the monthly payment for a $1,000 loan at annual interest rate of 8% for 30 years. This is basically what you would see in a mortgage loan officer's office. 8%, 30 years, okay? So you've got $7.34 for every $1,000 of a loan. If you took out a $100,000 loan, you'd multiply this by 100. That would be your payment. If it was a $500,000 loan, you'd multiply this by 500 because there's 500 thousands in that. So anytime you see this stuff, $1,000 loan, woo, 13%, good night, for 15 years, okay. $12.65 for every 1,000 you borrowed. So again, we're just doing a multiplier. 200,000, 200 times. 500,000, 500 times that. And so on. So again, the loan table makes it a little bit easier for me to figure out what it is I got. Monthly payment, Carol and Bill, $123,790 loan, interest rate of 5%, loans for 20 years, equal monthly payments, bind it. Okay. So the mortgage divided by 1,000. But then we multiply that. We go back to the chart again. 5% for 20 years, our multiplier is 660. So my payment would be like $817.01. Again, not including property taxes, not including insurance, not including PMI if I have it. That's strictly my monthly payment. And so, as I play with these, I'm just going to write under here, this is from the table. So if somebody's looking later, like, where'd you get 660 from? Right there. So, number of payments, because again, that's going to come into play when I'm looking for interest. On a 15-year loan, 12 months in a year, you're going to pay out 180 times. 20-year loan, and I'll mention this while we're coming up with these numbers. I'll have people ask me when I'm doing, personal finance stuff with people, well, why wouldn't I just extend it out here? Because if I can do it in 360 payments, my payments are only going to be half as much. True, but it also is going to take you twice as long, which means the interest is going to be significantly more. So all that money that you think you're saving, hey, I'm going to, it's only going to cost me half as much every month. I'm going to have that extra money for entertainment, buying other stuff, food, clothes, whatever. You're going to pay that back. You're not going to have as much as you think in extra. Whenever you can pay it off faster, it's going to be better for you financially. So, finding the total interest. Sheila and Nate applied for a $314,800 loan. Interest rate is 7%, 30 years. Equal payments. Okay. So, amount of the loan divided by 1,000. That hasn't changed. We go back to the chart. 7%. We want the 30-year plan here. So let's see. Sheila and Nate, what is your house payment going to be? Well, at least what's part of your house payment going to be? Oofda. So now, what's the total amount they paid? Well, and this is math that you can do anytime if you're trying to figure this out when you get a little older. 30 years, we're going to make 360 payments. Woofda. So we're paying slightly over $250,000. You starting to see the math here already? Whoo! So I paid, when I'm done paying off my house in 30 years. Now, hopefully my house is going to be worth significantly more in 30 years. That's the other thing we're hoping for. But if it's not... Ooh, that got all squished. Hang on a minute here. 438, 831, 20. I paid more in interest than I paid for the house initially, what it was worth. That's what happens when we stretch payments out. just to prove a quick point, and then I can be done and get out of the way and say, here's a couple things and be finished. Let's say, for instance, Sheila and Nate could have afforded to go at 15 years instead of 30. So if I did that, so let's see here. We'd have been at 7% for, not for 30, but here, so $8.99. So let's do a little quick math here and see what that would have saved them. You're like, Hardy, the house payment's bigger. You're right, but there's half as many payments. Check that out. 30 years, it cost them, sure, this much. 15 years, it cost this much. We saved just by same interest rate, did it faster, we saved almost $250,000. So if you can, when you go to purchase a house down the road, try and find something, if at all possible, that you can find your way through in a 15-year loan. If you can, you're basically going to have another house worth of money that you've saved. And you're going to be completely out of debt in half the time. So there's a lot of good to going faster and kind of putting off other things until that house is paid for. Just saying. Just saying. So I'll say what I always say, at least recently. Okay? Do halvesies. There's 2 at the top and 4 at the bottom. You know, do one of these and like 2 of these. That would not be a bad plan here. If you check the first couple and the first couple are right, you probably have got this down. It's not difficult math. It's just understanding what it means. And maybe, just maybe, especially on these 30 years, go back and check the 15 again to reinforce it in your brain for when you're down the road and you've got all your own money you're doing this with. Why you want to do it faster with the money to get out of debt faster, because, woo, that's a lot of cash you could be putting into a lot of other places. So play with those few.